With all the big buzzing business news of the day, I'm Vikram Oza with buzzing business news that we are tracking this Friday evening. You're joining us here on ET Now on our show Business at 9. The long wait for rate cuts by the US Federal Reserve now finally over, it would seem, because in the first concrete message that has come out on rate cuts by the US Fed chair, Jerome Powell, today he signaled interest rate cuts in the United States. He said the time has come to adjust rates. But he's also saying that the timing and the pace of rate cuts is going to be depending on the incoming macro data. Remember, he was speaking at that very anticipated Jackson Hole Symposium event taking place in Wyoming in the United States. So as part of his address, this is what he said.
We are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023.
So that's the word we got from Jerome Powell earlier. Let's decode all that he's saying over here. Anurag Singh joins us for that decoding. He's the managing partner at Ansid Capital. He joins us from Chicago, along with market expert Ajay Bagga. Great to have you both gentlemen on the show. Ajay, when you heard the Fed chair say that the time has come to adjust, what was your first reaction about the quantum and the pace of rate cuts? What do you think is going to happen?
Yeah, see, we have moved from if to when, and now it is a question of how much. So very much baked in for a September rate cut. First relief, because 2022 was a bitter lesson when he spoke so much about economic pain to come because of inflation, and he tanked the markets. 2023, the lesson was well learned, and today he was dovish as anticipated. The only issue is, Vikram, when the data is dodgy and you continue to be data dependent, your models are not working in terms of forecasting, it leaves the market clutching at straws. And then what happens? Every data point sees a very volatile reaction. That's what we are seeing. Today markets are up on anticipation of the rate cut, but he remains data dependent and event dependent. So overall, September is baked in. Directionally, he has said we know the direction. Third, he's also chosen to give the market some amount of reassurance, saying that we have a lot of ammunition because we are sitting at 5.25 to cut rates fast if there is an issue with the labor market. So some amount of reassurance as well. Markets reacted positively. Bond yields went down. Stock market went up. Dollar became weak. Gold went up. All on anticipated lines, Vikram.
Anurag, do you agree about the dodginess of the data, which is actually making the markets as skittish, like Ajay is pointing out? Because if that is the moving piece for the markets, and if we're going to have knee-jerk reactions, then the kind of statement that we're hearing, we are certain about when it's going to start. But the pace, if it's going to depend on the kind of data that comes in, that still remains a question mark for the markets, doesn't it?
No, so not really. Vikram, look, I think Chair Powell clearly expressed his confidence that he is now sure that the risks to now is more to unemployment side and not to the inflation side. And by the way, the numbers are pretty clear, and I think that that spike and the kick of inflation kind of has cooled down now of late, and especially with the housing slowing down. But here is the catch that they are in, Vikram. If you go before pandemic and after pandemic, there is a marked change. Chair Powell spoke about it. US lost about 4 million workers till 2021. Now, since then, there has been some recovery, but we are still short of about 2 million workers. So there is still that wage inflation, which is underlying all of this. So I understand they have room to cut, but I think broadly all they have is about 150 basis points. That is all there is on the table. Now, my sense is they will take next 6 meetings to do a 25 basis point each if the data continues to be favorable, and stop somewhere at maybe 3.5. So that's broadly the best the market can expect. We are not going back to 0 days, and I think there are a lot of reasons that we can discuss about.
Anurag, even while we're talking about the potential that the American economy holds, it wasn't too long ago, and Ajay, do weigh in on this, because the kind of pendulum shift that we see about the nature of the debate, the future of the American economy, whether there's going to be a hard landing, is what we were discussing just a couple of weeks ago. And look at where we are right now. We are very much more convinced about how the economy is going to stay resilient as far as employment is concerned. Yes, we have leeway within the kind of rates that we have right now, is what the Fed chair is saying. You seem to agree with that line as well. Ajay, so where does the truth lie? Because in terms of American economy, so much is based on how it will do in the future that you scratch your head and wonder.
Absolutely. And I run a very strong mutual admiration society with Anurag. So when he doesn't agree with me, I become worried. Why I called the data dodgy was because 800,000 jobs got cut out from the last 1 year's data.
Yes.
And you were taking decisions based on that data.
True.
So your data is wrong. And you keep saying I'm data dependent. Your forecasting models are obviously not working in a digitized economy. What is saving all these errors, the E&O line in the Fed's decision-making, Vikram, what is saving them is the $1 trillion fiscal deficit. So when you have a 4.5% stimulus going year on year on an economy the size of US, it washes away all the sins. So, all the errors of omission and commission of the central banks are getting washed out temporarily because of that stimulus. But going ahead, your debt is going to be price higher. Anurag is spot on that they can't go back to 0%, not possible. The inflation will surge so high because on one lever you have the fiscal deficit printing notes like anything, and you're monetizing that deficit. On the other, if you overstimulate an economy like this, it will just, the inflation will spike and you become an Arthur Burns while you are hoping that you see Paul Volcker in the mirror. So that is the dilemma they are facing. That's why I think they have been behind the curve. The only hope is, when something like a US economy gets to stall, then it falls like a plane when the engines are stalled. It doesn't gradually crawl to a slowdown, it falls off a cliff. That is the risk we are running.
Yeah.
And given their forecasting has been so poor, Vikram, that's what you have to be afraid of.
That's something to be afraid of, Anurag. I don't know whether you now agree with what Ajay is saying, but as far as the potential of the American economy, we bank on that. Here in India, the IT sector as one piece definitely looks forward to what the economy is going to bring in the future. What's your sense?
So absolutely, look, and I think good. I'm glad Ajay sir brought this point of deficit. The economy, I mean, at full employment, you are running a 7% fiscal deficit, right? And nobody is talking about it. That remains a constant overhang on the economy, and Federal Reserve is aware of it, right? Given the conditions, they have to operate within that. So I mean, look at how markets react. Like just about 15 days back in the yen carry trade fiasco, people were talking about Fed should come out and call an emergency meeting and do a emergency 50 bips and all that. And look, here we are, back again. So I think Federal Reserve is acutely aware that in the medium term, there are inflationary pressures on the upside. So they have room to cut, but about 150 bips is all there is to it. And I think they have to constantly be aware of these overhangs. One is the labor force participation, that has been on a downtrend since 2000. It's not now. I mean, it touched the peak at about 67, 68, and now it's close to 63 and slightly below, and it's not inching up. So that's one overhang. Second is the demographic retirees that in US constantly put a pressure on Medicare, Medicaid, which puts pressure on US fiscal deficit. So that's the second overhang. So of course they can't let their guards down. So I think there is room to cut. And by the way, they have achieved the unthinkable, right? We never thought this could be done without recession, right? And they have almost pulled out an rabbit out of the hat, so to say, right? As Chair Powell said himself, right, that even after we are long gone, this period will be analyzed for as to what happened and why it happened.
Yes.
So we don't really know.
Yes.
Yeah.
And history will judge how the Fed has done in kind of maneuvering the economy through a difficult patch like this. But the RBI seems to have done well, and some people have been talking about that to a great extent in the kind of ratings that the governor has been getting. He ranks among the highest. So in your sense, is the Indian market going to be happy hearing what they are from the Fed chair, Ajay? What does it really bode for them now that we have a sense of the rate cuts happening in September?
It's very strongly correlated with emerging market flows resuming. Growth and momentum stocks in emerging markets get a bid up when rate cuts happen. So good news for us. The yield, it was very easy to sit in a 5% US money market. I think on the incremental basis, there is $1 trillion which will come looking for yields. It won't come into equities, but a portion of the incremental flows will start coming into EM equities, while that $1 trillion will go to junk, will go to high yield, will go to EM sovereigns. So they will get flows coming in. And as the rate cuts take hold, and the 2-year starts coming down further, you will see more money going out of that US money market pool and getting allocated globally. So good news for us. Again, the big part is, Vikram, normally rate cuts are not good for the markets because it's either an incipient recession or already happened recession. This time is different, very dangerous words to say in the markets, but this might be a shallow soft landing kind of thing which they have engineered. That's the best case we have right now. So we are saying the impact on the markets might not be as bad. Out of the 8 rate cut cycles, you see 4 were shallow and the market cuts were very small, and they recovered quite well within 10 months. But there will be a market fall within 1 to 3 months. That is a 100% scenario for a rate cut. Only thing is, it might be shallow this time because the economy is not at stall rate right now. That's the good news. But good news for India overall, EM flows will come in and we'll get that 22%.
So, yes, so when Anurag says that they've pulled a rabbit out of a hat, perhaps is true to a certain extent, but the other overhang that you didn't touch upon, Anurag, and very quickly you must do it, is whether you're going to have a rabbit pulled out of a hat when it comes to the outcome of the American presidential elections, and how that is going to change the game for the markets as well.
So Vikram, it's a very tough choice out here, and it's so surprising how one side is running almost without any agenda, right? No policy disclosures, nothing. It's
Right.
almost like vibe and happiness and joy and whatnot, right?
Yes.
But Vikram, we lie on the, so I don't know where people stand. I think people will take a sound judgment. I think it's choosing a
Even without an
less.
economic policy.
Yeah.
Even without
Yeah,
that.
no, yeah, I doubt how many. I mean, if the politicians start believing that people don't really care about it, then I have a reason to worry. But between politics, always they say is choosing the lesser evil or the lesser devil. I would say known devil is better than the unknown devil, I would say, Vikram.
Yes.
Look, we are market people, Vikram. We don't like really the strong hand of the government, which usually the left represents. So in this case, with all credit to Madam Harris, I don't think their policies are really sound for the markets or even for the economy overall. I don't think that's the streak of US. So
Right.
hopefully, yeah.
Yeah, so perhaps it's a good reason why Mr. Trump doesn't want to disclose any of his economic kind of agenda items. And he might do well on the back of that. Who knows? We'll have to wait and watch. It's something that we are doing very closely, aren't we, Ajay? But thanks very much. Anurag and Ajay, thank you very much for lending perspective on what the Fed chair has done. It's great having you on the show, as always. Meanwhile, on the